Hey everyone, in this video I've got one dividend stock that's down 64% off the high, that's trading at a really cheap valuation that I think makes an excellent investment today. Now I'll go over what this dividend stock is and why I think it makes a good investment for passive income investors. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, the dividend stock I'll be covering in this video is 3M. 3M has seen its stock price come down 63.6% off its high as it's hit with a multitude of factors that's brought down its valuation. Notably, the company's involved in several litigation lawsuits that's impacting the company's profitability to the tune of several $billion. On top of all that, the company benefited when people were spending more money on things and less money on services, and that's been changing in recent years given the economic reopening has unleashed consumer demand for away from home experiences. Things like travel are not helpful to 3M, which benefits when you spend more money on things. So these several factors have hurt 3M, but it's also brought down the stock price. So it could be time to say, okay, you know what? The company's been beaten down enough. The valuation is down enough. I think it's a good time to come into this dividend stock. Notably, 3M offers passive income investors a 6.39% dividend yield. That's a robust dividend yield. That's more than investors can get if you were to buy, let's say, a 10-year government bond, which is trading at or offering investors a yield of less than 5%. Now, those are different investments, to be sure. The government bond is a lot less risky than investing in 3M. But just to provide a context for reference, if you're trying to generate passive income, that's the baseline I like to compare to with the government bond because it's offering such robust yields as of late. So if you're going to try and entice me to invest in a dividend stock instead of a government bond for passive income, I've got to have an attractive total yield opportunity. Total yield, not just dividend yield, right? We want to look at what we can get from this investment, inclusive of capital gains and dividend yields. So that's why I go beyond just looking at the dividend yield when I'm considering investing in dividend stocks. But let's stick with the dividend for now. Let's see how sustainable this dividend is. So in order to understand dividend sustainability, you've got to understand the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. All right, so now that you've got an understanding of that payout ratio, you can see for the better part of the last decade, 3M had sufficient earnings per share to pay out its dividend, right? You can see the orange is the dividend per share, the purple is the earnings per share, and the purple was well above the orange for the better part of the last decade. That is until the last year, year and a half. This is where the impacts of those lawsuits are bringing down profitability, bringing down earnings per share, and making it seem like 3M's dividend per share is at risk. But in my opinion, I don't believe 3M's dividend is at risk all that much, because these accounting changes are mostly that, accounting changes. I'm going to show you its cash flow from operations. And I want you to understand the difference between cash flow from operations and earnings per share. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. All right, so now that I've clarified that, you can see its cash flow from operations has been positive for the last decade, well positive, 20.44%. And the reason for this big difference between negative earnings and positive cash flow is because some expenses are non-cash. These lawsuits, these settlements, even though the headline number might be, let's say, $8 billion, right? That headline number, 3M is able to account for that right now. They can say, put it in their expense and say minus 8 billion accounting expense right now. But in reality, the terms of that agreement could call for 3M to pay out, let's say, 35 million for 20 years. Instead of paying out the 8 billion up front, they could sign a agreement where they do a payment term for a long period of time. So cash is not actually leaving the company, or not very much cash is leaving the company every year, while they can take the tax benefit of that settlement immediately. So there's a lot of accounting concerns to take into account when you're looking at these settlements, and it's not as bad as initially reported. And then finally, the valuation is really cheap. 3M is trading at a forward price to earnings of 9.176, the cheapest this stock has been going all the way back to January of 2021. And given that analysts on Wall Street expect the company's growth to improve, right? They expect 1.5% revenue growth in 2024, not exciting at all, but that's expected to more than double to 3.3% in 2025. So accelerating revenue growth is always appreciated when I'm looking at an investment. And going forward, you can reasonably expect 3M to deliver mid-single digit revenue growth. This is not going to be a double-digit or fast-growing company, but mid-single digit is reasonable. And given this valuation, that kind of growth is attractive. So for all these reasons, I think 3M is an excellent dividend stock to buy at these really cheap prices. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.